Hi, I'm Madison Malone, and in this Eyes on Tax series, we are talking about taxes on property and land sales. And I'm joined by Mark, Ian, and Alan from BDO. Thanks so much for being here, guys. Appreciate it.
Thanks. Nice to be here.
Mark, I'll come to you first. Say I had a property like a house or a parcel of land that I was considering selling. What are the parts of our tax regime that I need to be thinking about and considering as I enter such a scenario?
Perfect. We love talking about land and tax as tax practitioners. But the first thing I would like to say to you, Melly, because we have this over and over again, is don't take tax advice from persons you drink with in the pub. So they'll tell you two things. The first thing they'll tell you is New Zealand doesn't have a capital gains tax. So therefore, we're not going to tax your land sale. And the second thing they'll tell you is you could do this 2, 3, 4 times a year and you won't have to pay tax. That's how the rules work. They don't. So our tax rules with respect to the sale of gains on land are far wider than just Bright Line. And we'll talk about Bright Line in a bit. But we have a rule that looks to tax the sale of land if you originally bought it to sell it. So if your plan was to buy it and sell it like a single trade or a speculative deal, we're going to tax it. We're going to tax it if you're in the business of dealing in land. Our tax rules look at whether or not you've subdivided the land. Is it a minor subdivision? Is it a major subdivision? When did you do it? How did you do it? We're going to look at rezoning. Has the land been subject to a rezoning? There are all sorts of areas in our Tax Act which effectively recharacterises what the individual might see as capital to income. So your parcel of land, if you want some tax advice, the answer is it might be. Need more detail.
Ian, it sounds like in the eyes of the law then the scenario matters. It's not just the testing of time under things like the Bright Line test. Can you explain in more detail?
Sure. Look, tax is all based on the facts and the circumstances, and so they're absolutely critical. And of course, we get different rules for residential property and commercial property. The Bright Line test was originally brought in to stop having unnecessary arguments between taxpayers and inland revenue around whether if I bought a residential property when the market was hot and I sold it within 18 months, I must have had an intention of selling it when I bought it. But there's lots of situations where I might have had a change in circumstances. I might have bought a place thinking I was going to live in a small apartment. I've got married, I've had a kid, I now need a bigger apartment. I've sold it quickly. So if you had the hard line, Bright Line at 2 years was designed to stop those sort of quick sales from having that an unnecessary argument. It extended out to 5 years. You could argue about that period. Then it went to 10 years. And at 10 years, well, that's anybody know what they're going to do in 10 years' time? I don't know. So there are the facts and circumstances are really important. And in Mark's, he's mentioned developers and dealers, and then it's people who are associated with them. The rezoning is there's lots of different types of rezoning that can capture it. And in all of those sections, there are some exemptions that are available. And it's really about going through those facts to see whether some of those exemptions might apply.
Alan, what if I don't make a gain on the sale of my parcel of land or home? What about losses on land sales? How does that work?
Good question, Maddie. If you fall under one of the taxing provisions and a gain would be taxable, then generally speaking, the losses would be deductible as well. So you would have to fall within one of the taxing provisions that Mark and Ian referred to. And as I mentioned, if you do and you make a loss, then generally speaking, that loss will be deductible. One issue, though, is if the loss relates to residential kind of property, there could be a question as to whether that loss is able to be offset against other income, because for residential property we have loss ring fencing rules, and you can generally only offset against losses relating to residential property income from residential property, and that could be rental income or it could be gains on sale of certain residential properties as well. But those rules are quite complex, and as Ian mentioned, the devil is in the detail. The facts are all important, so you do need to get specific advice to enable you to ascertain, what the situation is in your particular circumstance.
Anything else you want to pick up there, Ian?
Yeah, look, in some of those timeline questions, it's also, we've got different rules for the Bright Line as to when the start date is of the 2 year period and when the end date of the 2 year period. But if you're in one of those 10-year rules where, say, you were an associated person with a developer or a dealer in land and you'd held it for more than 10 years, that timeline is different as well. And if you're doing a minor subdivision, say you're cutting off the back section into 3, and you do some of that work within 10 years of owning the property, that could trigger the sale of that, even if you sell that outside of the 10 years because the activity took place. So there's huge amounts of traps loaded into that tax legislation for land. So it's kind of like how we like talking about it, because there's complexity and there's lots of stuff to work through.
I was just going to add to what Ian is saying, Maddie, about the complexity, and particularly around the associated persons rules. There are lots of traps for the unwary in those rules. For example, there are actually 10-year timing rules for associated persons. So when you purchase land, if you're associated to a person who's in the business of dealing or dividing land or in the business of erecting buildings, so a builder, and different rules apply depending on whether you fall under the first two, so in the business of dealing or subdividing land compared to being in the business of erecting buildings, in other words, a builder. So different timing kind of rules for the 10-year rules apply to that. But the important point to note is for the associated persons rules, and we often refer to these as tainting rules. So if you're associated to a person at the time you acquire land, so associated to a person who's in the business of dealing in land, then that land for you would generally have a 10-year tainting period. So if you sell within 10 years of acquiring it, it could be taxable unless an exemption applies, which kind of Ian referred to. So we'd call that a temporary tainting rule. But there's also a permanent tainting rule, which sounds as bad as it is. So in other words, if you're associated to somebody who's a developer, so let's say you're in a group and you've got a developer that has developed a whole lot of sections, built some houses on them, and then sells one of those completed properties to a person that's associated to the developer, then we call that a permanent taint. So the associated purchaser, if they ever sell that property in the future, it will always be taxable. There's no exceptions, no 10-year rule. It'll be permanently tainted. And we see that where people fall into that trap. And it's a common mistake, and it causes a lot of grief. So people need to take advice when they're buying property if they are associated to someone in the business of dealing, dividing land or erecting buildings, in other words, a builder.
Alan's point is really, really well made. That associated permanent provision is so often missed, and it's a real trap. But to Ian's points on timing, I think it's really important to note that you have some control in this regard. You have some control. So if we just pick on a really, really simple example, and the team talked about the 10-year rule. If you hold land for 10 years, you should be okay under certain provisions. Let's say I've held land for 9 years and 8 months, and I'm looking to dispose of it. If I dispose of it within 10 years, it's taxable. So the question is, from a tax planning perspective, would it be prudent just to wait 4 months till I tip over the 10 years and then start to looking at disposing of it, and then it's potentially not taxable? So I think that's just a point to make in terms of timing. You do have a bit of control.
Thanks, Mark. Ian, is there anything else that somebody in such a scenario should be thinking about?
We've really talked about the income tax rules, but don't forget there is some situations where GST will apply, that the level of activity that's going on is enough to force a person to be GST registered. If they're selling to developers, there may be compulsory zero rating for GST. And the timing of GST as to when the time of supply is triggered for GST purposes is all factors to be sorted out.
Alan, to finish on a more positive note, are there any other considerations that are within someone's control?
There are, Maddie, but could I just sort of touch on something that he said, if that's okay? So just in terms of GST, Ian makes very good points, but I would just like to add to that often with land transactions, GST can sometimes cause the most issues, and it can be fraught with problems in terms of whether something, as Ian said, is compulsory zero rated, if you're GST registered and you're selling to a GST registered person who's buying the land for use in their taxable activity, but there's a whole lot of fish hooks, and you can end up in a whole lot of trouble if you get it wrong. So advice around GST and the income tax provisions is really important. But just to go back to answer your question, one of the things to bear in mind with all of these provisions as well is in terms of, we're talking about gains, and generally, so gains are taxable. As I mentioned, losses may be deductible in certain circumstances. But when we're looking at the gains, the important aspects of that are, the sale price and the cost. So it's only the gain that would be taxable if you fall within one of the provisions. And in terms of the range of provisions that we've talked about, for most of them, you would be looking at gains based on cost of the land. But the good news is there are some provisions, for example, if you've held land for more than 10 years and you engage in a major subdivision, then you actually reset cost to market value at the commencement of that subdivision scheme or undertaking. And that can be quite useful because you effectively get all of your inflationary gain out of the tax net, and you're only paying tax on the gain that relates to the subdivision activity. So that's a really important point. And there are other provisions that enable you to sort of carve back some of the gain. For example, if you're taxable under the rezoning provision, which is generally if a land's been rezoned in relation, and you've held it for less than 10 years, generally speaking, you get a deduction of 10% for each year that you've held the land. So by year 10, you don't pay any tax on that gain.
Thanks, Alan. Mark, to wrap this up, can you rattle off the provisions to those rules for us and any positives that somebody in such a scenario should be thinking about?
I think that's a good idea because there's a huge amount of information. There's a myriad of rules. We've got different timing, different this, different that. So in terms of just summing it up, we have a number of provisions. We care about if you bought land with the intentional purpose of sale. We care about if you're in the business of developing, subdividing land. We care about if you've subdivided land within 10 years. We care about if you've done a major subdivision after 10 years. We care about land that's been subject to a rezoning and has been sold within 10 years. And most of the world really cares about bright line and thinks that if they're over that, they're out. That's not quite correct. But I think with the land taxing provisions as well, we need to understand that there is some fairness in there. So the concept of your home as your castle, that still stands within our land taxing provisions. Most of our exclusions are around the family home or the main home. As Alan pointed out, there's some wonderful exclusions or exemptions or relief for major subdivisions, so effectively protecting that capital gain until up to the date you've started it. We have what we refer to as a taper relief for the rezoning. So that's an overview, but it really is just please be careful, seek advice. It's not what you hear in the pub. Watch out for GST and subdivisions. I'll leave it at that.
Thank you all so much, Mark, Ian and Alan. Appreciate it.